Welcome to the show, everyone. It's the Crypto Lark. Today, I got to sit down with Boris. He is the co-founder and partner over at Game Theory Group, a venture capital fund. Boris, welcome.
Thank you so much for having me. I'm excited to be here.
Absolutely. I really wanted to have somebody from the VC world on because I think it gives everybody out there a really great perspective on what you guys are looking for, because you're like the ICO gurus to an extent, because you're out there, you're finding this stuff early, and you've got a list that you look at when you say, hey, I want to go invest in something. So let's start off there. What does a VC firm look for when investing in an ICO?
So there's a number of things, and we do have what you might call a list, and it's a checklist before we'll even sit down with a company. As you can imagine, and I'm sure you get this yourself, we get hundreds of pitches a day. They come through LinkedIn, they come through Twitter, they come through email. I don't know if there's any chat app that they haven't come through. And so the first thing that we do is we analyze the publicly available information. And for that, we do have an analyst. He is our technologist in resident from MIT. And what we basically do is we see if the company is what you'd call legit. And legit for me means that they have a professional presence on the internet where their community building aspects have been with integrity. They've posted the information that we believe the wider audience should be able to see. And I'll get back to that in a moment. And when we examine their white paper or whatever color they're choosing to promote at the moment for the paper, that the technological aspect is based on infrastructure. And I'll explain that in a second. For us at Game Theory Group, we believe that we're in this, 94, 95, whatever you want to call it, era of blockchain as compared to the internet. And so when we look at deals, we really think about what is helping to build the plumbing of the infrastructure for blockchain. What that means is that we're looking for solutions, layer 2, Gen 2, Gen 3. It doesn't matter if we're thinking about existing blockchains or new blockchains, but it has to aid the scalability, the transaction speeds, or accessibility of the tool set. And if it doesn't do that, we usually put it in a bucket. You can think of that. Many of the decentralized apps, many of the non-fungible token pitches are in that bucket of we're going to look at it later and see if it's interesting. I'm not saying that investors aren't looking at them seriously. You see Union Square Ventures put $12 million into CryptoKitties. So there's a very serious and early business there. But for us, we're really focused on infrastructure. And infrastructure teams have a very specific makeup that can blend what we see as private company management, which means they know how to operate a company that's based on infrastructure. And they also have, which is much harder to find, someone who has more of a public-facing figure. And the reason for that, and I'll leave this question with this analysis, we believe that ICO companies need to act like both private companies and public companies at the same time, and that's really, really difficult.
Nice. That's an interesting perspective, actually, to say, yeah, well, we need to have all this from you. And I absolutely agree with your focus on the infrastructure projects, build the plumbing of the blockchain ecosystem, because those are going to be the ones that in 5 years are massive beyond belief, and everything else is going to be being built on top of that. But the dApps that are being built right now, that's a little more hit and miss. Now,
well, yeah, I mean, if you look at, and I'll send you the link later, there's a link where you can load the current iteration of the BBC on a 1994 modem. It sort of recreates that. And that's how I really think about a lot of blockchain projects. Like if you try to do that on a 94 modem, it takes something like 12 minutes. No one's going to wait 12 minutes for a website. And many of these companies that are building on top of very, very slow blockchains are just not going to be able to participate, even if they're successful in marketing. They're just not there in production yet.
Well, that's it. And we see, obviously, currently with Ethereum, we have untold amount of dApps that are going to be actually starting to deliver products this year, but Ethereum's not ready. It can't handle that transaction load yet. And I know the team's working very hard to try and move that forward, but the reality is it hasn't happened yet. Now, what worries big money, big Wall Street money, big institutional money, what worries them about cryptocurrencies, and why have they been slower to get into it?
Absolutely. So I think the number one thing is custody. I was at a private roundtable a couple of weeks ago with some of the experts in the industry from some of the larger companies, and we were specifically there to brainstorm on custody. And we know that there are a couple of solutions out there that allow you to hold larger chunks of capital, of Bitcoin or tokens with some of these institutions. But at the end of the day, most of the investors I talk about are still using cold storage. I think everyone's at this point heard this story of Ari Paul at Block Tower literally wrapping it in saran wrap and putting glitter on it, taking a picture of his cold storage, whatever it is, a Ledger, a Trezor, or whatever else, and then burying it. And the idea is that you can't randomly recreate this glitter so he'll know that it's tamper-proof. I mean, we're talking about archaic ways of custody. And the problem is, for the amount of capital that we're talking about, institutional capital, you need a balance sheet the size of State Street. So until State Street is willing to take custody of digital assets and insure it in a way where you really feel safe as maybe the manager of a family office, where they're not paid to take risks with the family money, they're paid to make sure that there's steady growth. So until we see a custody solution that is enterprise grade, I think we're gonna not see that institutional money come in the way people think it is.
Very interesting. Now, we were talking a little bit before we started recording here about really, I guess, equity versus tokens and how that's all playing out. Can you give us a bit of an expansion on, I guess, how a lot of companies are looking for equity, or some ICOs are only offering equity? And then can you give us a bit of details about that?
Sure. So I think most folks are familiar that when buying private company equity, what you get typically is some thought of governance, right? You might get a board seat, you might get voting rights, you might get a preferred stock where you get your money out before others. And those mechanisms were built in to protect the investor. What you're starting to see is that the more savvy investors, especially those that are writing bigger early checks, are getting the opportunity to both buy equity in the company and participate in the token presale. And there's a couple of things that I'm seeing. I'm obviously just one data point. I'm seeing companies that are willing to sell equity, but then tell the investor they have to buy the token separately. I'm seeing deals where you get some equity and you get some percentage, let's say, of the management team allocation. And then I'm seeing what's right now known in the industry as a little greedy, which is if you get 5% of the equity, you also get 5% of the tokens. But those deals are all over the place. They don't always track together, but it's changing, because just several months ago, I wasn't looking at really any equity deals, though I'm sure some early investors were.
Very interesting to see. Really, I guess ICOs in of themselves are probably getting a bit more savvy to the whole business model and to what they're asking from a VC firm. Now, as far as what you can offer, so a lot of ICOs aren't even going to ICO anymore. They're simply getting sold out in pre-sales to VC funds. Why is this happening, and what is it that a VC fund is able to offer to an ICO that, Joe Smith, the investor, is not able to?
Well, the first is you're issuing tokens to an accredited investor. And I think that we all know there's a whole bunch of regulatory overhang that needs to be dealt with, some for better, some for worse. Some are starting to focus heavily on the AML KYC process. And so they're only selling to accredited investors. Frankly, many of those are found within institutions. And so I think a lot of large check writers or large holders of crypto are setting up their own little funds. So you might think of them as institutions, but they're really one or two person shops. So what do they offer? I think, like most founders, and I've been a founder myself, I'm a founder now, you don't want to deal with 70,000 investors if you can avoid it early on. I mean, if you actually think about it, and I was giving this analogy earlier, you have to be a public company CEO and a private company CEO at the same time, and that's a lot of work. So if what you can do is early on manage the investors that you have, make sure that they have a direct line of communication to you, which is only possible if there's 10, 20, 30, 40, 50 people, then you might see benefit in doing that. There is a trade-off. The trade-off is if you do go the crowd sale route and you deal with all of the regulation, or you just don't do it in the United States or China, then what you have is a whole lot of people holding what you might consider a utility token. And so more people can use it, more people can trade it. You think of it like having a larger user base. So I think for some companies that makes a whole lot of sense. And for those companies, they can either do the crowd sale or do an airdrop, which we can talk about. But for many companies, really, they just want to capitalize their company, build, and then maybe go list themselves on an exchange. So it's a trade-off.
Yeah, I can see a lot of the I guess the old concepts of money raising really kind of playing out to an extent with ICOs for some of these really professional teams. You know, they think, okay, well, let's keep it simple. Let's get 20 investors instead of, like you said, 70,000 investors. But what we have been seeing a lot more recently, and I know quite a few ICOs very recently have gone this route, and I think we'll see more and more go this route. We have very large pre-sales to either accredited investors, venture capital firms, or more strategic partners. And then we have a very small percentage, say, for example, 3 or 4% of the tokens actually being airdropped out to 30,000 people, 40,000 people.
That's right.
Why do you think this model has been becoming so popular?
So we've discussed the regulatory aspect of this, and I think there's lawyers that have weighed in on both sides where that helps you avoid some of these security offering problems. But I think honestly, most airdrops are done to build the community. We know that building a community on Telegram, on Twitter is important because you want to have an audience for when you do go big and make announcements and all that kind of thing. And obviously, sometimes you have a product, often you have a product that you want people to use. So airdrops are a really intelligent marketing tool. This isn't the first time that people have given out free usage of their product in exchange for building community. I mean, look at Uber. They offered you $10 for a free ride. So this is a tried and true marketing method, and I think that it's been largely effective to build large communities. The problem that I see with airdrops, and this is where I'm not quite sure how long they're going to continue to do this, if you give someone something for free, the value of that something to someone is much less than if they paid for it or worked for it. And I think that's just something that you have to think about in game theory and gamification in general. If I gave you $10 worth of Bitcoin before Bitcoin was popular, before you thought that it was going to increase in price, you might easily sell it for $8. Boom, you just made $8. And I think that's where we are right now with a lot of these tokens. People are taking their airdrops and selling them for a big cap that they really like.
Yep. I imagine that's happening a lot. Although the interesting thing is that it's like you said, the community hasn't been built before the money was given out. But in a lot of situations, that can be a massive mistake. Of course, cashing out for the $8, right? I mean, look at what happened with Ontology. They did an airdrop to their newsletter.
Absolutely.
Now that airdrop's worth $10,000. So, people could have got out early and taken the early gains, and it still would have been very profitable. But there's definitely a benefit in actually trying to invest in your community. And I've actually seen a few ICOs recently where in order to participate in the airdrop, you actually have to, go to a physical location, and they literally give out money at certain points in a city, or you have to, write them a letter saying why you like their stuff. And you can say it's kind of a bit silly, but at least it's going that next step instead of just saying, hey, just sign up to our Telegram, we'll give you free money. It's at least saying, hey, engage with us a little bit, and then we'll give you free money. So.
Yeah, I mean, you've seen examples of that. I think QuantStamp was one of the first to have this proof of caring system where if you lock up a certain amount of QuantStamp, they'll give you a small percentage of any company that they audit. I think those are all very clever customer retention tools, and some of them will be successful, some of them won't. But I do think that at the end of the day, with Ontology, for example, what you have is a very interesting business. And I think if you asked people right now, for example, is this a good time to sell Ontology? I think they'd have a really hard time answering that because there's just not a lot of information out there yet. So for many of the folks that held on or sold, it was a lot of speculation from an airdrop perspective. I think you asked me earlier what the difference is on the investor side. So I do think that the investors got interesting look in the underpinnings of what Ontology is trying to do, and I think they saw a lot of potential. But I don't think that the general community has had an opportunity to do that for most of these products that are coming out. And so right now there is, I believe, an insider advantage to some of these larger investors because frankly, if you're writing a check for $1 million, you have a little more leverage to learn a little bit more. And I don't mean that in terms of like what exchange will you be listed on, because I think most of these smart projects are not having those discussions, but they might be able to tell you about partnerships. They might be able to tell you about new hires, who they're recruiting, advisors, and all of those things are super important for the longevity of these things.
That's it. It certainly gives you that extra bit of credibility when you walk in the room, and versus the investor who's saying, "Hey, I'm bringing in $100 here," and that investor is important too. But you do have to look at that, and it's so hard too because, as we mentioned a little bit earlier, there's so many projects coming out every day that it's getting to be very difficult for these companies to actually try to build communities, get anyone interested, to get their attention. It's very difficult because it's just this constant flow of blah. ICOs coming out, which is absolutely crazy. Of course, that means this funding model is become incredibly popular. Now, what about red flags? When you guys are looking at an ICO, I know we talked about what you look for in particular, but what are some particular things you go, yep, that's a 100% no for us?
Yeah. So for us, there's a couple of red flags. The first is if they don't have all of their legal, at least to the best of their ability, but preferably completely in order. For them, it's actually a larger risk, I believe, than for us. I mean, at the end of the day, if your token is named a security, which might or might not happen, your investors are basically given an option to ask for their money back. And this has happened before. You see that in the US. So we're not looking for our money back. We're looking for a return on investment, or we're looking to support an awesome project. But there's a big community out there and someone might. So the legal aspect needs to be nailed down. We also are very, very hesitant to invest in projects that have more advisors than team members. You're starting to see this shift, I think, in the communication in the community, right? Like, before, advisors were everything. You had an advisor that could make your ICO. I think now what you're starting to see is there's really interesting and valuable advisors that might be into cryptography. They might understand marketing, whatever. But people are starting to be more cautious about accepting the title. And I think that's because if you're just seen as an ICO advisor, not only is there some regulatory risk, but realistically, how many of these people are really helping these projects go the distance? I mean, how much time does someone have to be an advisor for 46 different projects? And so I'll often interview advisors and ask them specifically what they've done for the company. And if all they've done is put their name up there, that's a massive red flag, which means it should be a red flag for the company when deciding who to use, not just for the name, but go for the actual assistance that this person can provide. Or don't do it at all. Do it behind the scenes. That's my view.
That's a good one. I like that. You invested in ICO. How do you determine when to get out? What's your rationale behind getting your sell points together?
Yeah, so I think I first heard this from Kyle Samani at Multicoin, whose tweets I highly encourage people to read, and they have some really interesting stuff on their website. We look like they do for 10x or 20x deals. I mean, we do want a return on investment for our LPs and for ourselves. And so we constantly reevaluate deals almost every week, sometimes every week for certain deals, on whether or not this remains a 10x investment. So how do we evaluate that? Well, we look at the token economics of the deal. We look at the community. Is it growing? Is it slowing down? We look at new team members, specifically folks that can help push the product forward, either from a development perspective or from a marketing perspective. And I do believe there's a lot of missing gaps in a lot of these projects where they're not spending the time they need to get true marketing and business development people, but in their vision, they're going to be working with every enterprise company in the world. I mean, those things don't happen by accident, and very rarely do you get, a large bank or a large fintech to approach you and say, hey, we just heard you raised $25 million. Like these other 75 projects, we really want to work with you. Business development is a process, and you need to build a pipeline. And so build a pipeline, quote, public company CEO, so that you can continuously have interesting things to give to the community, but that are actually meaningful and move the company forward. So those are sort of the primary things that we look at to evaluate if this remains what we'd call a 10x deal. And if not, typically the way that we sell is predetermined based on whether or not we think that this deal remains interesting to us in the sense that I just mentioned. So for us, we're not day traders, we're not swing traders. That's not our background. My team is entrepreneurs and operators. So we'll basically just say, look, if we've gotten to the point where we no longer think this is a 10x deal, then we're going to sell half now and we're going to average out over the next 2 months. Typically, we try not to flood the market with our ownership, and typically we'll be already in some sort of lockup or something like that, where we won't be able to necessarily sell all of our tokens, which is actually another thing that you're seeing more and more of. A few months ago, I didn't see any of those lockups, and I saw Team even sometimes only locked up for like 2 or 3 months because they could get away with it. As the market is maturing, you're starting to see big investors get locked up and team members get locked up like you'd see in traditional startups, which is at least for 4 years in order to have access to all their tokens.
Yeah, it's really interesting to see the disparity between the traditional investing world and what's demanded and the ICO world because the demands are still much less. I mean, you say, 4 years for a sort of a traditional company for lockup on their stocks. Well, a lot of ICOs, if you can get, a 1 year lockup, you're kind of lucky. But like you said, it is developing. I see more and more 2 year lockups or 3 year lockups coming through. So it is definitely developing in that sense where ICOs, I think, are really trying to be more professional because they realize if you want to get the money from the VCs, if you want to get, money from serious investors in the crowd, you got to be more serious yourselves. So I think it's a really good thing to see the ICO market developing like that.
Absolutely.
What about failed investments? I mean, when do you decide to cut your losses? Because this happens with some ICOs. They come to market and then blah. So do you decide to ride them out, or do you say, okay, if we're at 50% loss, we're cutting it and moving on?
So we don't really look at it in terms of the price, but what we do look at is, do we still believe this thing has 10x potential? I think that the problem, if you literally set a limit, like it goes below 50%, we're done, is that you're really ignoring the fundamentals of what makes the company you invested in really interesting. Are they down by half because the market is down by half? Are they down by half because of an announcement that they didn't make, that the community wanted them to make? All of these things, I believe, are somewhat frivolous for sort of the medium and long term, but they're very painful in the short term. And so we don't do short-term deals, right? That's not really our focus. We look at least for the medium or long term. We might, and if I see something opportunistically, we might invest in something with the intention that it's going to be a 3 or 4 month deal, but that's incredibly rare. And that would be done only if we thought that there was a specific short time horizon where something big was going to happen that would really drive a return. But for the most part, what I really look at is, are there market conditions that are driving the price lower than what we were expecting? Or is it something that the company did incorrectly and that's why we have liquidity? Certainly we could sell our position. But in terms of failed investments, I think that from our perspective, there are some things that absolutely will go to zero. I mean, in fact, some could argue that 90% of these things will eventually go to zero. And that's because a lot of them have big dreams and big aspirations, but a limited war chest compared to some of the major players out there. Not every blockchain is going to survive. And I think some of them will end up having to write off. And that happens typically with every venture capital investment as well. So you have to be able to stomach a certain degree of risk in this industry.
Yeah, well, the idea is that, some of them are going to fail, and that's an inevitable situation. And I think a lot of maybe the newer investors to the space may not fully realize that you're investing in startup companies when you invest in an ICO, and that some of these are 100% going to fail. Some of them are going to do amazingly. Some of them aren't. And I guess you guys at the VC firms, you think, okay, well, a certain percentage are going to fail, but that's just part of the business. The majority are going to do really well, and, we'll take that margin as we can get it. So
yeah, and I think we're going to see more and more of that play out over the next couple of years. I think many projects just haven't had the time it takes to completely fail, especially when they've raised $20-30 million. You can keep going for a pretty long time with that kind of money.
Yeah, that's true. That's definitely, if you can't make it work with $20 or $30 million, you can't make it work.
Unless you're Enos.
Okay, so next up I've got some questions for you from some users over on Twitter. So Mickey SMID Music asks, how much of your own capital would you put into the crypto markets today?
Would I? I can say what I've done. So I've been in the space now for almost 2 years. So I think I've had ample time to make those investments. Approximately 40% of my net worth is in crypto, and that's been slowly increasing. A, with the appreciation of certain investments that we've made, and B, as I become more and more comfortable with the space in the long term. I expect that most folks don't or should not have that much exposure to crypto, but I do feel that I should participate heavily in an industry that I hope to help build.
Yeah, absolutely understandable. That's I think for a lot of people, what the problem is, they simply don't have the time to be following all the investments as they really need to be. If you're invested in 20 different companies, you need to have the time to sit down and follow those 20 different companies. For some people, maybe just buying some Bitcoin and holding on to that's the best thing you can do. And that's kind of, to the extent that Bitcoin is worry-free, a worry-free situation. Okay, next one up for you.
Well, certainly.
Go ahead.
Oh, go ahead.
Okay, next one up for you. What trends do you, this is from the Count of Monte Crypto. What trends do you see in 2018, 2019, 2020 moving forward? Where do you see the space developing in about 5 years' time? Do you think it's going to be, the dot-com bubble all over again, or do you think it's going to be more of just a gold bloom situation?
Yeah, so I think we've already had a couple of these dot-com era busts. Maybe they weren't as bad as some people expected. I think we're going to see them again. 2018, though, here's what I think is going to happen, and here's what's already happening. Some of the best talent, technical talent, marketing talent, sales talent, executive talent, is being gobbled up by blockchain companies. Some have been tokenized, some have not, like perhaps Coinbase. But you're starting to see some of the smartest and most ambitious people moving into the space in droves. So here's what I think. I think we're in a period of building. Yep, sure, we're going to have some bull and bear markets and cycles. But at the end of the day, right now, people need to put their heads down and build the stuff that they promised they'd build. And once we start to see the fruits of that labor towards the end of 2018, some fruits of the labor, especially companies that ICO'd last year, I think you're going to start to see not just an increase in market, just in general, but I think you're also going to start to see proven use cases for a lot of these projects. And what I think that's going to drive is a feedback loop of more smart people getting in, companies being built. So if you're actually thinking about it, if you're following the smart people and the smart money is following the smart people, you're going to see that the problem I laid out, like in custody, someone will solve that problem. I mean, State Street doesn't want to stay out of the game. I haven't spoken to them, but that's my guess. They want to build the solution because a lot of people, and I've talked to a lot of institutions across different wealth managers, family offices, they're getting calls all the time from people that are interested in exposing themselves to this asset class, but they want to do it in a safe and measured way. And as we solve these problems, I do think this problem is going to get closer to being solved by the end of 2018. You will start to see the institutional money coming in. I think 2019 is probably going to open up the faucet a little bit more and a little bit more and a little bit more. I don't think we're going to wake up one day and like 17 different major financial institutions are going to announce that now they're in, right? I think the way they're going to see it is they're going to test it $1 million, $10 million, $100 million, and then all of a sudden a certain percentage is allocated. And what that'll hopefully bring is lower volatility to some of these big caps, because it's the more money you have, the less you see the price move. And I think we all want that. I should say that many of us who are making investments don't want volatility in every single token that we invest in.
And I think for a lot of people who do the swing trading, they love the volatility, and there's a lot of volatility to be in the market right now, and it makes so much money for people who are, riding the waves up and down. But for long-term investors, and that's really more of my mentality at long-term investing in a lot of these projects, the volatility is just, it's part of the wave, but the wave is moving in a positive direction. So there's definitely a lot of potential here for the whole market moving forward. So anyway, Boris, I think we'll go ahead and finish up there. This has been really awesome to get, to be able to pick your brain and get some of this insider insights into what is going on in the VC world. So thanks for sitting down and taking the time to share your thoughts with us.
Yeah, I'm psyched to be here, and we've been watching you from the beginning, so we're big fans. Thank you.
Thank you.